Hey folks, we are on the sidelines of the release of the FY25 numbers for NCBA Bank, 24 billion shillings in net earnings for the year ended December 2025. And you're privileged to have Mr. John Gashora. We have really sat down with this gentleman this quarter. Gashora, karibu sana.
Thank you, Julius.
Congrats on the numbers.
No, thank you. Thank you.
Strong funded side, strong non-funded side. Maybe let's just start by your sentiment around your F25 numbers.
Yeah, so as you say, we've reported 24 billion in net earnings, a very healthy growth, 7% growth from the previous year. And what is interesting or good about our numbers is there was also top-line growth. I think we had gone through 2 years where top-line growth was actually zero.
Yes,
we were flat. 23, 24, I think
Finally,
these were our numbers. We've moved quite significantly in top-line growth, 17% growth. And that is in all sides. Yeah, it's both funded and the non-funded side. If you look at the non-funded side, our transactional income grew at a rate of about 16%. Yes, we had a bit of a dip in our digital business from a revenue perspective. Obviously, from a bottom line perspective, we did very well by managing the risk side of that business. So we're quite happy. And then there is a balance sheet expansion as well, which has been flat for a couple of years. You look at our total assets, we grew 8%. So again, positive growth. You look at our lending, it has grown. You look at our deposits, they have grown. So pretty much good growth, and this momentum that it's continuing certainly into 2026.
And the dividend is quite fantastic. I'm surprised you haven't mentioned that.
And then the dividends. Well, you know, that is now leaves the company. I was talking about what came to the company, right? What left the company? Certainly, I think the board has been very generous to recommend to shareholders a very healthy dividend of 7.1 shillings, total dividend for full year, 4.60 4 shillings 60 cents as the second and final dividend. I think that should be very attractive to any investor. Not to mention the fact that we're in the middle of a transaction that again puts a lot of value into the hands of shareholders.
No, and there's a lot to unpack on that side, but let's continue first on the earnings, John. For all the green sports that we have talked about, one of the areas where I feel that you still have some work to do is on the cost of funds, and I'll tell you why. If you look at it structurally, CASA is just about 53%. When I compare you with your peers, they're playing in the low 60s, mid 60s. Don't you feel you could have done a lot more to preserve your margins here?
I think, first of all, if you look at our NIM, net interest margin, it has grown significantly. And in fact, part of the reason our operating income grew by 17% was because of the growth in net interest income, which grew at about 24%. That was precisely because we controlled the cost of deposits. Now, it is the case that our funding structure has always had a 50-50 mixture between CASA and term. And indeed, even now, as you say, we're about 53 CASA and 47 term. So we play around that area, let me be frank. And that has become the profile of our funding. Now, a lot of it is because of when we became into Tier 1, right? We became a Tier 1 bank recently, right? If you compare us with other banks that we were playing with when we were all Tier 2, that profile of banking is what you find. That profile of deposits is what you find. Now, two things to note. One is that those who have a high percentage of CASA tend to be banks that have been around for a long, long time, and therefore they spoke to government. A lot of government payments go through them, salaries, police salaries, teacher salaries, and other things will go through them. That count as CASA for them. There are those who have had international corporates with them, who attract of international corporates. So again, a lot of that transitory investment money will go through them and be booked as CASA. But for more newer banks, the profile that you have seen with ours is what you see with theirs. What we've been able to do, however, is attract even the term deposits at a much better rate, and that's why our net interest margin has grown the way it has. We've always said that we do very well in the low interest environment because of our structure of deposits, and that is proving very, very true. Do we need to change it? Look, I think given our branch network, I don't think we'll change it as quickly as we'd want to. We have no desire to be mass market, to build so many thousands of branches, yeah? And therefore, I don't think we'll be changing our profile that quickly. But what it also does for us is to make our cost of funds very, very predictable. And that we're able to do then to translate that into how we price our assets, our interest earning assets. So that does help us. Lastly, I would say this, is CASA is transitory. Yeah? And it's transitory so much so, and I bet you if you look at banks when interest rates were very, very high, even those banks that have had traditionally very high CASA had to come to the term market and borrow and take money from the term market quite significantly because CASA is transitory. For us, our structure actually remained the same. If you look at our percentage CASA and term, even during that period, it sort of remained the same.
Okay. Away from the core banking business, your subsidiaries are also performing quite well. Investment banking, quite a strong point there, man.
It's done very, very well.
Yeah.
And really all the three businesses that we house as Investment Bank have done very well. We have a brokerage business. Yeah. One of the things that we've been trying to do, and I think we finally started doing, is break into the institutional market. We've been very strong on the retail side for a long time. Now we managed to break into the institutional side, and we have had some significant trades being done through our brokerage. So that is one that did very well. If you look at advisory business, did a lot better. And a lot of it came from now finding the synergies between the main bank and the investment bank, where a lot of the deals we were doing, we tried to do them in-house. We are not very good at it. Or we end up participating in deals done by other investment banks. What we have done is to say our advisory work will come from our investment bank. And indeed, the structuring that needs to be done for the deals we participate in, it's coming from the investment bank. And insisting that is the deal that is being done, and it's being done by a number of banks. We don't go to another investment bank to do the advisory. Ours must be included if we're going to put our balance sheet behind it. And that has helped us grow that business quite significantly. And I think the last one where we have seen massive growth is on assets under management within our wealth management.
100 billion.
We hit 100 billion. And very, very quickly.
Yeah.
Julian, you may recall when we merged, we were about 25 billion is what we had in that business. A lot of the growth has come in the last 2-3 years. And that is because we have been very deliberate on two levels. One is that cooperation or that synergies, building synergies between the core bank, our retail business, and our wealth management business. We used to have retail customers who want higher yields going to other banks.
Yes,
and we have said, no, how can we keep them? How can we give them better yields? That's number one. Number two is the return that you find with our investments. Yeah, I know we don't talk about it. And I've seen there are a lot of funds out there that are talking about these very high returns, and I've seen the growth they have managed to get from talking about those returns. We deliver exactly those returns ourselves. We don't talk about it because people should not just come to us for returns. Yeah. People must come to us for returns and safety.
Yeah. I
think we provide such level of safety to these wealthy customers who want to get a higher yield. And I think that is part of the success that we're seeing as grow that rapidly.
And how is the insurance going? Early days, I guess.
Early days. Insurance is an interesting business. But the thing we have done, which I think is very good, is we have said we will grow our insurance business profitably. This market has very large insurance companies, I'm sure you know.
And some, perhaps too many.
Perhaps too many. A lot of them don't make money.
There you are. There you are.
If you're to break out the insurance businesses that we have in this country, and you look at where they make their money, very few make money from insurance business. A lot of them make money from investment income, right? Either they are life insurance companies, in which case they have gotten all this money waiting for us to die to pay us back, but during that time they make money investing with our money, right? Yeah. What we have been very clear about is our insurance business must make money beyond the investment income. And that is part of the reason why any dividends that they can pay, we take that money because we don't want them to get comfortable that they will get all this investment income because of the amount of money they hold. And so the growth that we have seen, significant growth already in that business, we're doing it very profitably.
Okay. Yeah. John, your subsidiaries in the banking space across the region, how soon before they start paying back a dividend?
Well, I can tell you that one, they've all been profitable. I think you've seen that. Each one of them profitable consistently for the last 3 years. Yeah, they have returned profit. This year, one of them, and I can say Uganda, for example, the board had recommended that they pay a dividend to the group. Yeah, and so I think we're at a level where we're starting to get dividends from these subsidiaries.
Okay.
Yeah.
But from an efficiency standpoint, there's quite a struggle there, John.
The efficiency number that we track is a bit, it's not misleading, it's the right number, but it has to be understood in context. When you build a banking business, there's minimum fixed costs you must have. There are a number of deviations that are prescribed that you must have.
Yes.
Right?
Yes.
And certain people you must hire at certain levels, right? Isn't it? And so that's a fixed cost. You cannot do a bank, for example, with less than 100 people, even if you had one branch. It's not possible. It's not possible, right? Because you've got to have your compliance, you've got to have your risk, you've got to have your audits, you've got to have all these things that you must have.
That's
right?
your baseline.
It's a baseline, right? And therefore, when you're small, the opposite of economies of scale come in very strongly. And that is why the cost to income ratio in these markets tends to be very high when you're small, which is why it's important to scale up. As you scale up, those 100 people you started with start serving a lot more businesses, a lot more customers. Yeah? And therefore, for us, what we are doing is to try to grow these markets. We're investing in branches. You saw now Rwanda, we had 10 branches, 3 more be it during the year. Uganda, we have expanded. Tanzania, we actually first reduced the branches, but I think we're at a point where now we're starting to say we can expand our branch network just because we need to bring more customers to be served by this fixed cost base that you cannot do away with.
John, we have another meeting after this, so let's close this. Netbank. We have had this conversation with you quite a bit, so maybe just give us a status update. What are the major hurdles you have crossed now?
I think a few. Obviously, what we're going through is now the regulatory approvals, yeah? And that takes quite a bit of time. I think when we announced it, we said we expect to close this in third quarter. That still remains the milestone for us. That's where we intend to close. I think a couple of things. One, we have followed the timelines as laid out by the Capital Markets Authority, and that we have done at every juncture. I think one of the biggest wins that you would have seen is that Netbank got approval not to make a takeover offer.
Yeah.
That's new in this market, by the way. I know people didn't talk about it a lot, but you don't get to a point where you're allowed to go out and say, I can only take 66% of your shares. Yeah, usually you have to offer, and you see what comes back, isn't it?
Yes.
But here they've been very specific. We're offering to take 66% of your shares, and that's what they will be buying. Yeah. Obviously, in our memorandum, I think you've seen there's a leeway to take a bit more. But at least they have been allowed to go out and say this is what we are willing to take. So I think that was a big step forward.
Final question, John, is this. Section 44 of the Banking Act has refused to go away. Yes. We are still having conversation around loan pricing, and do we need to get approval from the National Treasury, and how should banks then transmit this? What are your thoughts?
There's something called cleanup that we're not very good at, sometimes as a country. And I think that's something we need to really start being good at, because Section 44 should have been cleaned up a while ago. When we're getting the new constitution, there's an opportunity to clean up. When we did the interest rate capping,
there's an opportunity there.
There was an opportunity, right? And that should have been cleaned up because we ignored it during that whole period, right? We ignored it. I mean, there's no way you could have had interest rate capping and that section coexisting. It's not possible. So cleanup should have happened. We didn't do it. Here we are many years later when it's coming to bite us, and we realize we actually need to go and clean it up. It's a bit more difficult now. Why? Because everybody is saying, but you banks, you're charging such high rates. This one allows us to control you a little bit. So that's a problem number one. It's not being used, but someone would say, but it retains some power to use. It's a problem number one. Problem number two is that nobody thinks it affects banks anymore, right? Because you've been running a business for so long, people are asking, why do you care, right? So it's a cleanup that is necessary, yeah, but it's not needed now, right? From the banking side, we think it's needed now. Why? Because it exposes us to a lot of risk. And that risk, if it manifests itself, is going to increase the cost of borrowing. That's number one. Number two, the fact that now we have a risk-based pricing formula that incorporates within it directly monetary policy decisions, either the CBR or Kesonia, which are monetary policy decisions. it then automatically means it's interfering, yeah, with the ability of the central bank to transmit its constitutional right on monetary policy.
Yeah.
So it means that we have a problem, isn't it? It means we have a problem. So I think it's a cleanup that we must do. Last cleanup that we must do, even as we do that, is the fact that we must give customers notice when you change their rates,
Yes.
right? I know that the central bank has told us takes effect.
It should be immediate.
It should be immediate. But again, we agree. But let's do the cleanup. Yeah, we need to do a cleanup on the laws, because somebody might come back and say, well, I don't care what the central bank told you. The law says X. Yeah?
Yes.
So those cleanups are the ones I'm talking about, that there are a lot of things we need to clean up. And I know that the central bank is going through a process of cleaning up the prudential guidelines, for example. It's also the right time to clean up the Banking Act.
Friends, unfortunately, we have to close this conversation at that point. We've been having a chat with John Gashora, the man steering NCBA Group on the FY25 earnings, as well as the latest on the Netbank acquisition. We shall keep you updated as and when anything emerges. Stay tuned.